Should we just invest our entire accounts into Yieldmax's ULTY ETF? Because after all, it pays around a 100% dividend, and with the $1 million account size, we could earn around $1 million in dividends and retire early on ULTY. Yieldmax helps me earn over $650,000 in dividends, as you can see below, and we're outperforming all of the indexes with Yieldmax and margin. We're up 9% for the year. The rest of the indexes are basically flat to start the year. So we're living financially free out of our brokerage accounts using Yieldmax and margin. If you need help doing the same, email me for my e-guides at akintodd48@gmail.com. Our margin debt is around $615,000, but our dividends of over $650,000 will pay that back in around 1 year. I'm also not worried about my margin interest because I've negotiated down twice. Many of my clients who bought my e-guides did the same thing. All right, so let's weigh the pros and cons of this idea on going all in on ULTY, because again, if it has around a 100% dividend, right now it's about an 85% dividend, but sometimes it's over 100%. If it has around a 100% dividend, why not just put it all in ULTY and then get $1 million in dividends to retire early on and also pay down your margin faster with? If you use your income from your current holdings and then you use some margin with income, combine the two incomes together, you're going to really pay down your margin quickly, which then adds to your market value, because once your margin debt falls by the amount of dividends that you receive, your account value also rises by the amount of dividends you receive. So let's explore this idea closer. First of all, if I were to put my entire account into ULTY, then I would actually raise my available withdrawal, because if I put $1 million into ULTY, then I would have $500,000 of available withdrawal, because ULTY is 50% maintenance. If you need help understanding maintenance, that's in my Volume 3 e-guide. So with my current setup as it is, we have over $360,000 available withdrawal. That means that we can withstand over 20% corrections thanks to my low maintenance names. Yieldmax is 50% maintenance in many cases, and ULTY is 50% maintenance. So that actually sucks up half of your equity. But if you were to put your entire account into ULTY, you would actually raise your available withdrawal, because 50% maintenance on $1 million invested, again, that means that I have $500,000 for available withdrawal left. That puts me in a much better position to withstand margin calls and live financially free out of my account, because I want to be able to withdraw out of my account at any time to pay my bills. So even when you're not using margin, you want to have low maintenance names so that you can withdraw freely out of your account. So I like that aspect of raising my available withdrawal by about 150 grand. But my only fear is, what if E-Trade raises the maintenance and puts me in a premature margin call? So I don't think I could ever put all of my account into ULTY. Of course, I could put my whole 1 million in ULTY and they raise the maintenance, but I can't be using any margin. But I always want to be using margin because I always want to get ahead. All of the greats that I know have used debt to get ahead, and the reason why I'm outperforming the markets, being up 9% year to date, is because I buy things that are low volatility, that fall less on down days, and I'm using my margin and the dividends from that margin to double my performance. Again, many people would say, well, if you're using that much margin to double your performance, well, what if you have a big down market? You're going to double your declines. Well, that's not true, because again, I just told you I invest in low volatility names like Cornerstone and Defiance that fall less on down days. Now, what if we were to find another broker that kept the maintenance low for ULTY? Okay, let's just assume, for example, that we're at another broker, again, with lower maintenance, and they're not going to raise that maintenance. Would ULTY be a good idea? I mean, look at the chart of ULTY. It just goes down on its chart, okay? Everyone thinks that ULTY is a declining investment, and it's a yield trap, perhaps, because it gives you a huge yield, but look at that declining NAV on the chart. Well, as I always say, you have to factor back in dividends and drips, and in this case, our margin usage to get our true performance with ULTY. So again, if maintenance isn't an issue, should we put our entire account into ULTY? It's not the craziest idea. I mean, look at the holdings of ULTY. It actually has some pretty high quality names: Coinbase, CrowdStrike, Dell. It has Robinhood, some Bitcoin names like Mara. It has Intuitive Surgical, which is a great healthcare play. It has some great semiconductor names like Micron. It has Misty. It has Nvidia, Netflix, Palantir. It has small cap ETFs like TNA. It has TQQQ. All of these are very fast moving names that are actually pretty high quality, and that's where the yield comes from in ULTY. The 100% yield comes from in ULTY. It's from these plays that have high volatility, okay, high IV, implied volatility. That's how Yieldmax works. Everyone always asks me, can these Yieldmax dividends last? Well, of course they're going to last, because it's based on the implied volatility of the holdings. As long as the holdings have high IV, which all those holdings average high implied volatility historically, well, then you're going to keep getting high premiums or high distributions from your Yieldmax Yieldmax ETFs. It doesn't matter if Yieldmax ETFs go to zero because they're going to reverse split and keep the dividends coming. When reverse splits occur, your dividends do not change. Go look it up. That's the biggest myth with Yieldmax investing, is that it erodes, and then if you have a stock split, it's going to take away your dividend. Well, that's just not true. Again, go Google a definition of a stock split. You'll see that nothing changes with the dividend. So ULTY has pretty high quality holdings. It's always going to have that high of a dividend because those names always have high implied volatility. So we're going to continue to collect these dividends in ULTY of around 100%. So why not put it all in ULTY? Well, as I just explained at the beginning of the video, I'm scared of a maintenance change with ULTY, all right? Now, assuming that a maintenance change won't occur and assuming maintenance isn't an issue, well, then the other factor I have with ULTY is that it falls harder on down days than indexes. ULTY obviously has high beta names. If you're not using margin, you still want to watch out for ULTY and the price drops it could have on a given down day. But if you're using margin, you especially want to stay away from these high volatility names that can drop big on a down day. So in my opinion, it's best to stay diversified in names like Cornerstone and Defiance, which I keep saying. Cornerstone gives you a 20% dividend, and it drips that dividend down at the NAV for 32% gains every month. So we're all getting ahead of my channel thanks to Cornerstone and its drips, okay? You get days gains with Cornerstone, you get the drips at the NAV every month for 32% gains every month, and you get the rights offering opportunity in Cornerstone, which tells you when to buy and sell, and that helps you really level up your account because you never know when to buy and sell the S&P before the music stops, but Cornerstone tells you when to sell, and then it tells you when to buy after the rights offering is over. If you need help playing Cornerstone, that's in my Volume 4 e-guide, and when you buy my e-guides, you get free access to Discord for life, where we alert you of the Cornerstone rights offering announcement. We have over 1,000 members here in the Discord chat. We're pursuing the FIRE lifestyle, so if you ever have questions about your brokerage account that I can't answer, someone here in Discord most likely can answer for you. So we have to stay in our index plays like Cornerstone and Defiance because they fall less on down days, and staying with the indexes is the only way to beat the indexes over time because 90% of traders fail over time. You can't time the indexes. You have to just buy the indexes and go away. And so if I'm using my margin, then we're going to outperform the indexes because whatever the index does, I'll do times 2 thanks to my margin. But you have to stay in low volatility names like Cornerstone and Defiance. I really love Defiance because today, for example, the NASDAQ was down 1% to start the day, and Defiance was only down 0.5, okay? So a lot of times, Cornerstone and Defiance, again, will be down much less than the market, and that helps minimize our drawdowns in our account when we're using margin, and that's what's been helping us outperform the market, even with the slow start to the year. Cornerstone also keeps its dividends steady in a down market, and Defiance will actually raise its dividends in a down market, whereas ULTY will cut its dividends in a bear market. So you have to be careful with ULTY in a down market because it's going to decay from its dividends. It's going to drop big from the down market, and it's going to cut its dividends, which is going to cannibalize your account if you stay invested in ULTY and keep reinvesting in ULTY. So even though I like the idea of ULTY and its 100% dividend with 50% maintenance, which keeps my available withdrawal at about 500,000, even though I love that idea, I've given you 3 reasons why you can't just go all in ULTY so far. It could have a maintenance change, it falls harder in a crash, and it's going to be cutting its dividends in a bear market, which could potentially cannibalize your account. Of course, I keep all of my money in the indexes like with Cornerstone and Defiance, and I keep smaller amounts of my money in ULTY, but I have stepped up my position in ULTY to a pretty significant position size. If you ever want to follow my portfolio, just click the membership section on my YouTube channel, and you can go follow my FIRE portfolio at any time. All right, so that's how I stay protected. I stay in the indexes, most of which are low maintenance names. Cornerstone's 30% maintenance, Defiance is 30% maintenance. I also keep put options on at all times, just in case we were to have a crash overnight. So if we were to have a 30% crash overnight, my put options would be up thousands of percent in that event, potentially making us more money than we lost in that crash. If you need help hedging your portfolio with put options like I do, that's in my Volume 5 e-guide. All right, so if you need more help doing what I'm doing, email me for my e-guides at akintodd48@gmail.com. We're outperforming all of the indexes with Yieldmax and margin. You can do this too. Anyone can get ahead with margin because for every $1 you put in your account, you get $4 of purchasing power. I'm just using a fraction of this over $1 million in purchasing power to get ahead, and then my dividends pay it back at the end of the year, but play by the rules when you're using margin, okay? Remember, when you buy my e-guides, you get free access to Discord for life, where we alert you of the Cornerstone rights offering announcement. We also have other channels here for your enjoyment. They're all free. We have a Yieldmax channel here, Defiance, options, Bitcoin, you name it. So check these out when you get a chance. And you get my phone number when you buy my e-guide, so you can call me anytime you have questions about your portfolio. All right, so I really like the idea of ULTY and doubling my income and available withdrawal, but I listed 3 main risks that I think could deter this strategy, but please let me know your thoughts in the chat, everyone. All right, and if you like this video, please click like or subscribe, and I'll talk to you soon, everyone. Thanks.